All right, folks, we're back. We're back, and it looks like the housing market did a double top. What is a double top, and what does that mean for the housing market, for real estate, and for home prices going forward? Well, we're going to talk about all that and more today. Hey, everybody, my name is JJ. You're watching Bull Boom Bear Bust, back with another dose of economic reality. Bull to the Bust, BX4, back with a new camera. So before we get into it, new camera. I think this is my fifth or sixth camera that I purchased here because I keep getting negative feedback on the image quality. Somebody said you need a nicer camera, one with background blur. I had never heard of background blur, so I searched for background blur, and the camera had really good ratings. So now it's kind of blurry back there. You can't see the book titles because it's blurry. Somebody said that was better, but I guess that focuses more in on my face, and that could be a really bad thing. Now you're going to see every line on my face, and probably, maybe I didn't brush my teeth good enough or something like that. So could be a disaster. It could be good. We'll find out. Anyways, I'm putting a lot more money into this channel than it's making, unfortunately for me. So, but I'm happy to be here for you. It's not about the money. It's about getting the news out there to make awareness more common. And when it comes to the economy, we need a lot more of that. A lot of people just do not know what's happening, and not that I know everything, but I do a lot of research, I do a lot of digging, and I try to put common sense into it here. But let's talk about housing, real estate. One of the key drivers of the economy, actually the biggest key, or one of the biggest keys. I mean, consumer spending. When consumer spending stops or drops, that's when you really see the economy start crashing. Layoffs, job losses spike, unemployment spike. But the housing market, of course, huge, huge, huge. And let's go ahead and get a chart up here. And this is the double top that I want to show all of you. And this is out of Wolf Street. And we look to the right edge of the chart here. We see June 2023 compared to June 2022. Pretty much level. In fact, slightly lower last year than it was the year prior, 2022. Of course, comparing June to June. And when you compare June to June, pretty much even, right? But when you look at us compared to the peak, which was June of both years, actually, 2022 and 2023. I mean, again, a little bit less in June, a little bit lower. But we're down compared to the peak. Now, if you look at it year over year, we look back here 1 year, and we're still pretty much treading water. But the fact that we didn't go higher last June versus June of the prior year speaks volumes. Let's go all the way back to 2013 at the bottom left hand of the chart here. Every year was higher highs, higher lows, and higher highs. This time we did not see higher highs for the first time in like over 10 years. So folks, it looks to me like a double top. Now anything can happen. They could drop mortgage rates. Historically though, dropping mortgage rates this late into the economic cycle, into the bear market of real estate, typically dropping rates at this point doesn't stop the downturn. There's a whole lot of other intervention that can happen. They could freeze foreclosures. They could repeat 2020. Instead of correction in the housing market, you'll see prices go back up again. If that happens, they could throw a bunch of stimulus checks out there. Who knows? But just looking at the price action in the double top, that something that we look at. We look at that in the stock market. We look at that in charts, individual stocks, entire indices. We look for that double top. It's a big economic indicator and possibly a sign of things to come. What I've always said here is the level of intervention that we are seeing now in these markets is unprecedented, and it seems to be getting worse every time we see a downturn. There seems to be more and more of an effort to stop a price correction and to stop what used to be a normal market volatility or normal cyclical plays in the markets, right? We used to see booms and busts, but it seems like now they're doing everything they can to make the boom, but then doing everything they can to prevent the bust, right? So we're not seeing the correction to correlate with the boom, and that's leaving a lot of people under a lot of debt. And we're going to talk about the debt here in just a minute. But what do you think about this double top in this chart out of Wolf Street? You got to love Wolf Street. Check out that website if you ever get a chance. I'm sure probably a lot of you have already checked it out. So what does it mean? Well, we're going to find out in just a few months. We're in February, and we saw this June over June number that was essentially level at just over 400,000. By the way, the median home price looks to be about 405, 6,000. So this June, what is your call? Will we see much lower price than we did in June 2023? So right now we're sitting right at about, according to this chart, right at about it's like 70, 372, somewhere around there. So this summer, will we see a much lower low? I mean, you let me know your prediction down in comments. I will read your comments today in this video. Now, also, these are the National Association of Realtor numbers, and it doesn't include every zip code because even the NAR has areas that they don't factor into their numbers. And so this is going to be different than the Case-Shiller Price Index, which just has the top 20 cities for their main index. So that's why you see the numbers off, when you look at different bits and different data, depending on where you look, right? But we're going to keep an eye on it here. And of course, the housing market is something, that we all should really be keeping an eye on here. Oh, and still on the topic of the housing market, we're not finished. I want to bring this one up as well. Same article here. And we see existing home sales. And look to the most recent data here. And this is as of January. And we see, what do we see? We see this level as bad as it's been. In fact, briefly in 2020, we saw sales plunge before they spike back up again. But currently we're at where we were during the depths of the housing bubble going bust from 2008, 2009, 10, 11, 12. We saw sales that were really at the bottom of the barrel. And that's where we're at now. So what does this mean? A lot of similarities to the housing bust, folks. And it just dropped off here in the past, 2 years. We look at 2022's numbers, and they were amongst the highest that we've seen over the past 10 to 15 years. But now we're at near the lowest. So that's a plunge in sales. And what does that mean? Well, it's going to take time for sellers to get to the point where they have to sell. We did see a lot of desperate sellers back in 2008. Not so much now, and I should say not yet. But these levels of debt, they're not going to be easy for people to carry, especially a home. A home can be a money pit. It could be a good investment, absolutely, especially if prices are going up. But it can also be a money pit, and people are going to start selling when they see the cost of insurance this year. If they haven't got their renewals yet, this year's renewal for insurance is going to be a shocker, I think, for home insurance for a lot of people, amongst a lot of other things that are going to be budget breakers and financial shockers, right? So the housing market, keep an eye on it, folks, because, I've always said here that there wasn't going to be a crash just because I see all the shenanigans and intervention that is played in this market. I don't think they're going to let a crash happen, but a severe price correction, could be right around the corner. And, place your bets, right, as they say. Well, let's get into some other news here, going away from the housing market here, but still, of course, on the topic of financial. And moreover, on what we just talked about, Americans are facing a credit card debt crisis. And this is how it's being described out of Business Insider. And what's Business Insider saying? U.S. consumers are struggling with soaring credit card debt and rising interest rates. And that's another thing, too. A lot of homeowners with these credit card bills and the levels of debt at 20-something% interest, if they're not paying it off in full every month, it's going to be a matter of time before they're going to have to put their homes on the market here. Experts said the debt increase is most concerning for younger adults. Absolutely. Buy now, pay later programs could mean the problem was even worse than it appears. Yes, the credit card debt numbers are the worst they've been. This is all-time high credit card debt, but it doesn't even factor in the record buy now, pay later programs and the debt from those programs. So it's a lot worse than people realize. And I think this year is going to be, a lot of shocking things coming out of the debt market and just the consumer side of things. Of course, we have commercial real estate and that whole debacle with the banks. Commercial real estate is going to cause a lot of banks to implode. It's yet to be seen what type of rescues, what type of buyouts will happen. Banks coming in, bigger banks coming in, buying out smaller banks. and a lot of consolidation I see this year in the banking sector. All right, now let's go ahead and dig into the numbers with credit card serious delinquencies. These are 90 days plus, folks, delinquencies. We look at the blue line here, the credit card delinquencies just surged over 6%. I think just a few reports ago we talked about it was 5%, but now we've got the more recent numbers here, and it's over 6%. And of course, we see student loans way down because of all the rescues and the forgiveness that's happening there. But of course, 6%, not high compared to 2007, 2008 financial crisis. It actually spiked up to 11%. And of course, after that, we had rock bottom interest rates. So credit card delinquencies were super low over the past, over 10 years. But now a big spike over 6%. And how high is this going to go? And in just less than 3 years, we saw it go from about 3% to 6%. So it doubled in about 3 years. So will it double again from 6% to 12% in the next 1, 2, 3 years? If it does, we're going to be back where we were during the financial crisis, where it spiked up to, again, 11%. So pretty interesting things to keep an eye on here. And, I'm always on top of the credit card data, the debt levels, home prices, the housing market, all these big things, that affect the economy. Doesn't mean things are going to crash, no, because the amount of intervention, again. So people listening to this saying, well, this all means that there's going to be a crash. No. Look at what happened in 2020. They could change the game. They could freeze credit card payments. They could, what they can do, right? And I'm talking about the money creation, the money printers. And, what we've seen with the banks and how people were rescued. And we look at Silicon Valley Bank, a lot of billionaires were rescued. Normally, they would have lost their money because FDIC did not have enough to cover all of the depositors at the banks. And for example, Silicon Valley Bank had a lot of tech CEOs. It was a bank out of California, covering a lot of California tech companies, a lot of money. And what they did is they got together. We're talking about the Fed, the Treasury, and FDIC, because FDIC had between 1% and 2% of the money that they needed to actually cover all the depositors. So they had to team up with the Fed and the Treasury to actually rescue all these depositors, right? So that's what I mean by intervention. They moved the goalpost. They changed the rules at the snap of a finger. So no one knows exactly how this is going to play out. But, it is interesting, and it is, I think, smart to go ahead and keep an eye on the numbers, the data, the delinquencies, the home prices, the everything, right? The defaults, the foreclosures. We'll get more into the foreclosures here, a couple reports here down the road. Something else here, speaking of commercial real estate and some big problems with the banks there, look at this. Commercial foreclosures up 97% year over year, folks. That's almost double. When something doubles year over year, pay attention. And U.S. commercial foreclosures rose 17% in January alone from December. So in 1 month, up 17%. Now we're up 97%. At this pace, we're going to be at about 120% in February and possibly March. Adam counted 365 commercial foreclosures across the country. Wow, 635 commercial foreclosures in the first month of the year. This is just January, folks. 635 commercial foreclosures. These are malls. These are big office buildings. These are warehouses. The nearly 100% increase demonstrates the market that is navigating through a long-term economic shift following a global event. Yeah, a big global event. And a lot of people went to work at home, and you have a lot of vacant buildings right now. And hopefully they'll keep the work at home thing in place, because I think there's a lot of benefits to that. It's not so good if you own commercial real estate, but it's, I think more benefits as far as pollution and saving gas, and a lot of good things would work at home. All right, folks. So what do you think about this? The double top in real estate, what's going to happen this summer? And we saw June over June, 2022, 2023. This June is going to be the story, folks. So only a few more months. We're going to see how this all is going to play out. We've got a lot of other things happening. The truckers were going to boycott New York. It looks like the leader of that, or one of the leaders, or the main person, backed off. We'll see if the other truckers still step up and cause some chaos to New York City because what they feel is unjust justice system. Unjust justice system. All right, folks. We got to wrap it up. Thanks, everybody, for watching. Let me know what you think about the new camera also. Is it better? Should I ship it back? I'm still in the return window because I just got it. I think it's pretty nice looking anyways. But if it's too scary, let me know. Everybody, thanks for watching. Big love as always. Peace. Keep stacking. Bye.